Okay, hello traders, Dr. Barry Burns here. Let's talk about the rubber band trade. The rubber band trade is a trade setup that I give away for free to everybody who looks at my website and goes through my free 5-day video course. Now, I give all the parameters there. It's amazing to me. I get a lot of letters from people asking for clarification on a few things, and I find out they're not really trading the rubber band trade. Here's a basic principle you need to understand. A trade setup has very specific rules, and all those rules are important for a trade setup. So if you go and you say, oh, this setup looks pretty good, but I'm not going to include that rule or that rule, and I'll add a couple of my own things, you are no longer trading the trade setup. Okay, you've created a different one. So I find that a lot of people, they miss out on a few comments that I make in the rubber band trade video, and I don't know why, but they don't see it. Probably part of it is that there's certain parts of the rubber band trade that I can't really demonstrate on a chart to people. And so, for example, I mentioned the fact that if you're going short, you go short at a cycle high, and you go to your next higher time frame. You make sure that momentum is down on your next higher time frame. But because the people haven't bought my course yet, I don't show which indicators I use and what inputs I use for those indicators. I just tell them to use whatever momentum indicator they use, whatever cycle indicator they use. And then same thing with a 5-wave or 7-wave pattern. And again, a lot of people don't know how to measure those or don't measure them the same way that I do. So, without giving them my whole course, I can't show them exactly the parameters that I use to trade it. But I just invite them to use the indicators that they are currently using to measure cycles, momentum, and so forth, and waves. But I find that a lot of people don't use any indicators to measure those things. They're not familiar enough with those energies. They're not marking those energies on their charts. So anyway, you have purchased my course, and so therefore I'm going to go through and give you all the details exactly of the rubber band trade using my indicators. Okay, so let's get right to it. So the first thing we want to do is, again, just review the concept of the rubber band trade. It's based on following the 50 moving average. So we use the 50 MA as our intermediate term trend indicator. So basically, when the 50 MA is down, we're looking for shorts. When it's up, we're looking for longs. And we also understand that a moving average has a reversion to the mean type dynamic to it. In this case, literally reversion to the average. So what that means is the price will go back to the 50 moving average. It'll go back to any average. Just depends on how long or short that is as to how often it will do that. But the problem is, let's take an example here. So with the 50 MA angling down, we'll use the hard right edge of the screen over here. Okay, so we could say, well, reversion to the mean. Okay, so that means we want to trade the market back to the 50 MA. Well, the 50 MA is above price here, so we'd be going along saying that price is going to revert back to the 50 MA. Okay, well, if we go along here, okay, put a little purple dot there. Okay, well, the market went down, and again, the point is 50 MA angling down is in a downtrend. Okay, so we went long here. Well, market's down here, so we're losing money. We're still losing money. We're still losing money. We're still losing. Okay, so here, finally, the market did revert back to the 50 MA. It always will. But the problem is, obviously, we don't want to buy high and then sell low. So this scenario, just buying a reversion to the mean doesn't work. It's not profitable. It works in the sense that, yes, it always reverts back to the 50 MA, but can't make money doing it. So I looked at that and I said, well, how can we make money doing it? And like most things in trading, the high probability scenarios line up when something unusual is happening. You see, most of the time, I believe, and a lot of studies indicate that the market is just a random walk. So if we want to find a probability scenario, we need to find something unusual happening, because the usual is kind of chaotic and noisy and choppy. So how do we find something that's unusual happening? Well, based on this scenario, what we want to find is the same thing. We want to find, and it goes either way, but we'll just talk about market moving down. We want to find that 50 MA going down, but we want price above the 50 MA so that the trend is down, but the reversion to the mean, we have to short instead of buy. And again, we want to do that because trend is down, so we want to short. We don't want to be buying when the trend is down. We want to be selling or shorting. But we can't do that unless price is above the moving average. And the moving average is angling down. You can do it when it's flat too, but a higher probability trade is when that 50 MA is actually angling down and not just flat. So, does that happen very often? Well, no, but it happens often enough. It's not really that rare. Again, it's not happening most of the time, but it does happen periodically on various charts. Pretty much every day I'm finding rubber band trades on an intraday basis. So let's take a look at it and see now the rules that we use and how we set this up on our indicators. Okay, so what I've done now is I have brought up a second chart. And this just happens to be the Dow. Again, it doesn't really make too terribly much difference. Okay, there we go. Actually, I had to change one of the charts there. So this is the Dow, and we have a 100-tick chart, Dow futures on the right, and a 300-tick Dow futures on the left. Again, it doesn't really matter which market it is or which time frame. It's robust. It's going to be the same on any same setup on any markets or any time frames that you trade. I use this on daily charts, and I use it on stocks, futures, currencies. It doesn't really matter. The setup will be the same. All the stuff adapts because it's just measuring the energy. So the stochastics will adapt, the moving averages adapt, everything adapts to the market. Okay, so let's talk about this. So now, as you can see, the 50 MA here is angling down. Price is above the 50 MA. And that's what we want, so we're going to short. Okay, that's the basic price setup that we're looking for. So we're still trading with the trend. See, this is still a trend setup. The rubber band trade is a trend trade. We are trading with the trend. So, what are we going to look for? Well, we're going to look for a hook. We're going to look for a cycle high. We're going to go short the cycle high. Now, one of the questions that I get a lot is, okay, how do we pinpoint the exact entry and where does our stop go? And that's an excellent question, of course. So we look for, but the answer is very simple since you already know the trading methodology. It's really the same answer for every other trade. You just look for your 5 energies to align. So energy number 1, are we trading with the trend? At first you might say, well, no, because we're above the 50 MA. But the answer is the 50 MA is angling down. The trend is down. We're shorting, so yes, the trend is on our side. We are trading down. We're trading with the trend. The second energy is a cycle high. Okay, so we got a cycle high. Third energy is support resistance. And here, this orange line happens to be the 200 moving average, so we do have resistance, which is what we want. So that's the third energy. Now the fourth energy is we want to make sure that momentum is on our side. Okay, now this one gets a little more advanced. Is momentum on our side here? But first you might say no, because momentum is going up. However, if you use the technique that I teach you in Course 2, you count the waves on momentum, 1, 2, 3, 4, 5. Okay, we have a 5-wave momentum pattern to the upside, meaning that that's an average momentum trend, and therefore we would expect that that would be coming to an end very soon, especially since the trend is down. The price trend. See, there's two kinds of trends. Trend on price is measured by the 50 MA, because the 50 MA is measuring 50 bars ago. It's averaging the 50 bars, and those bars are price bars. That is the trend on price. Down here, our mom indicator gives us the momentum, and that's measured simply by the highs and lows that come in conjunction with cycle highs and lows. Okay, so higher high, higher low, higher high, higher low, higher high. That is a trend on momentum. Trend on momentum and price do not always line up. In fact, often they do not line up. That's why we count the trend on momentum separately. Okay, it actually tends to be somewhat of a leading indicator. Okay, so that's number 4. And then number 5, we go to our next higher time frame, and we want to see momentum down, just angling down. It's just all we're looking there for is mom angling down. And if we can get K and D angling down, all the better. So those are your 5 energies. Look for them all to align. That gives you your pinpoint entry. Then you say, okay, cycle indicator's hooked. I'm going to short 1 tick below the low of the bar that created the hook, and my stop will go above the cycle high. Just 1 tick, 1 penny, 1 pip above that cycle high. And that's it. So there's your risk. Now you want your risk to be roughly 1-to-1 to the distance between your entry and where the 50 MA is. Because the 50 MA, in this situation, will be our first target. Now, if the 15 EMA is between your entry and the 50 MA, then that's your first target. So whichever moving average comes first, that's your first exit. Now again, we're trading multiple contracts, so that's not the only target we're looking for. But that is going to be the first place you take some profits. Then you can let the rest ride according to your cycle indicator and our normal targets. Okay, so really, everything's the same. It's just a different setup, but otherwise, all the parameters are really very much the same. Okay, so hopefully that makes it real clear. Again, I'll review, and then I do want to show you one more thing here before we close out this video on this very, very powerful trade. I mean, I love this trade. I trade this thing every day if I can, if I see it. Okay, let's clean up our chart here and just try to bring some clarity by going through it a little quicker. Oh, yeah, one other thing I forget to mention is I also like to see a 5 or 7 wave pattern on price. Now, this is a very interesting scenario because this is 1, 2, 3, 4, 5 wave price. You might say, but wait a minute, isn't that a double bottom? Well, yes, but I still count this as a wave up. Okay, so the more bottom line is, actually counting that wrong, 1, 2, 3, 4, 5. Okay, if you're familiar with the wave counts, you can have a failed wave 5, failed wave 7. We still count them as wave 5s and 7s and so forth. Same thing on reversals like this. Even though this came all the way back down and retested this, that is still a movement up and down, and so we count it as a wave. 1, 2, 3, 4, 5. Okay? If it had come way down here, then then we would not count that as a 2, of course. Okay, so the more waves it puts in against the direction of the 50 MA, the higher probability that you're going to find your high. Okay, so a 3-wave pattern against the 50 MA, not as high probability short as a 5-wave. A 5-wave against the 50 MA, not as high a probability as a 7 wave. 7 wave, not as high a probability as the 9. The longer it goes against the 50 MA, the higher the probability is that thing's going to stop and turn and get back in the direction of the 50 MA. So if you want to increase the odds of winning, wait for 5 and 7 wave patterns against the direction of the 50 moving average. Okay, so the energies are, trend is down, so we're only going to short. We got to wait for price to get above the 50 MA, so we're trading with the trend. Energy number 1, trading with the trend. Number 2, we need some sort of resistance since we're shorting. Of course, everything's the opposite if we're going long. We'd be looking for support. So that's energy number 2. A cycle high is energy number 3. The more waves in momentum again you got, or if you get a little momentum divergence up here, all the better. But either a long wave count or a divergence on momentum gives you the energy of momentum on your side. And then the last energy, go over to your next higher time frame. Primarily, we're looking for MOM to be angling down. If you get %K, %D on your side as well, all the better. Okay, and then again, make sure you've got at least a 1-to-1 risk-reward between your entry and the 50 MA. Your stop goes right above the smallest increment possible, above your cycle high. And take some profits off right at the 50 MA. And then you just see how, here we've got this long cycle down, and so this turned out to be a really, really nice winner. Some of them only go to the 50 MA. Others, they plow right through it and never look back like this one. So that's why we let profits ride with some of our contracts, just in case, some of our shares, whatever. Okay, one more thing I need to show you before we close out this video. Let me change charts. Okay, I switched this over to the NASDAQ just because I knew a particular situation where this occurred here on the NQ. So, we're just going to look at this briefly so that you understand the pattern. 50 MA is angling down. Price is above the 50 MA. We have resistance here. 1, 2, 3, 4, 5. Everything's looking real good. Okay, now let's follow this a little bit. Now, here's the key. Remember, I said that your first target is the first moving average you run into. Here's a situation where the 15 EMA, the blue line, is above the 50 MA. This tends to happen when price moves further above the 50 MA. See, there's a lot of room now, more than a 1-to-1 risk-reward between the 50 MA and where you would enter, which would be under this, actually this green bar here. Let's see if I can show you that. Okay, so either that green one or that red one. But, so you're risking basically a bar, maybe a bar and a couple ticks. And because the red %D is already angled down here. Okay, so your risk is very small, your reward down to the 50 MA, better than 1-to-1. So this looks pretty good. Okay, let's see how it goes. So boom, there we go. We ran right into the 15 EMA. That's really where your first exit has to be. Okay, that's where your first exit has to be. So you really here, in this particular situation, because the 15 EMA is above the 50, you have to have a 1-to-1 risk-reward between the 15 EMA and your stop. I will often, in fact, do it with less than a 1-to-1. But you want something in the neighborhood. You want it to be close, not too far away from that. Now, so boom, up it goes. Oh my goodness. You're stopped out, comes back down. Look what's happening to the 50 MA. Now here again, you could say, oh, should I take another rubber band trade? But here's the point. While you're in this thing, see, when you entered, yes, the 50 MA was down at that time. It was going down. However, the 50 MA will, as as bars continue to form after you're in the trade, the 50 MA continues to move. And now look, it's no longer down. Now it's flat or maybe even slightly up. When you see this happening, even if now here we got stopped out, if you did not get stopped out, but you see this 50 MA starting to turn, you do not want to be in that trade anymore. Okay, if you didn't get stopped out and you're still in the trade, I normally get out, or at least I get out with a big part of my position, a half or 3/4 of my position. I evaluate the whole situation. You may want to just get out, because here's the bottom line. When do you get out? You get out when the reason for being in no longer exists. That is the bottom line on how to establish when to get out of the market. See, we get in on a short with a rubber band trade when the 50 MA is down. Okay, now the 50 MA is no longer down, therefore the reason we got in no longer exists, therefore we no longer want to exist in the trade. This trend is starting to perhaps either go away, it could just flatten out from here, or it could actually turn around and go up. So therefore this setup has now been negated. So bottom line is, after you get in, even if you get in for all the right reasons, continue to watch that 50 moving average. What you want to see is, as the trade progresses, you want to see that 50 MA continually angling down. If it starts to flatten out, that could be trouble. And if it starts to go up, it's definitely not something you want to stay in. Let's see what happened here. I already know, of course. Sure enough, that trend turned right around. Okay, we actually get a little mini one here. Boom, again, right off support. So, but this trend continued to go up and up and up and up. Quite a ways. Quite a ways. So, if you look back on it now, of course, it looks obvious, but at the hard right edge of the screen, that was a legitimate rubber band trade. And you can see why we use that 15 EMA as our first target when it gets above the 50 EMA. Because that 15 EMA is a leading indicator of the 50. It's a short-term indicator. And again, it's nice to get that price way above the 50 like this, but what happens when you do that is it means that there's even more of a pull in the other direction for that trend to change. And that dramatic pull away from the 50 MA does eventually affect the 50 moving average. It's a very slow indicator, but it will make that thing start to turn as the calculations continue to pile in bar after bar. So, little piece of wisdom there. Bottom line is, and this is again applicable to all trades, after you're in a trade and the bars continue to go and you're in it, continue to watch the market and make sure the reason you got in still exists. If things change, especially before your first exit. After your first exit, things start to get unaligned, and that's normal. But before your first exit, and until your first exit, things should stay aligned. All the reasons you got in the trade should remain. If they don't, not a bad idea to just bail and get out and wait for the next setup. Okay, so that's it. That's a good description of the rubber band trade using our indicators. Hopefully you found that real helpful.